Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. On this Tuesday, I'm going to offer a stock that's had a really good earnings report today, and the stock's up about 4%. The company is Jabil Circuits. It's headquartered in St. Petersburg, Florida, right in my backyard. It sells electronic components. And a lot of you may not have heard of the company. It's got about a $4.7 billion market cap. It's BBB minus rated, has about 51% of debt, offers just slightly over a 1% dividend yield with not a lot of dividend growth, I might add, and currently is available at a very attractive PE, in my opinion, of 10.45. But I wanted you to get a kind of an overall picture of this company. First of all, there's some very interesting lessons in valuation here. This stock, like most tech stocks, participated in the tech bubble. And we saw valuations get extreme, trading at just under 80 times earnings in August of 2000. And then, of course, we had this massive correction. I do want you to notice some cyclicality here, and I also want you to notice that the company does respond negatively during recessions, but it stays profitable, and I think that's very important. We had a nice spurt of growth coming out of the 2001 recession. The market got enamored with the stock, ran the PE back up to 30. Then, the company started paying their first dividend in 2006, and you can see they grew it very fast the first year. But then the dividend hasn't grown much after that, and I'll show you that in a little more detail. But once this stock got overvalued, ran into some earnings periods, we had some real strong weakness in the stock. But coming into the depths of the recession, the PE did get down to 5. And I might add, this would have been an excellent time to buy the stock. If you'd have bought it and held it to today, you'd have made over 22% per annum, annualized rate of return, including dividends on your money, with a lot of volatility in between. So I do caution you to watch out for some of the cyclicality. But let's look at this stock right now for a shorter time frame, because what's been happening over the last really about 3 operating years and a very strong forecast for next year, which I'll get into, the company's been growing at about 11% a year. The market's only been valuing the stock at around an 11 or 12 PE. If I expand that out to a 15-year graph, you'll see that the normal PE during this time was about 13. If I drop it down a little bit, you'll see the normal PE's been about 11. And this is something that I think is important because right now, tech stocks tend to be out of favor anyway, a lot of them anyway. Some aren't, but a lot of them are. And buying a stock at 10 to 12 times earnings is what the market is valuing the stock at. But even if it stayed at its normal 11 PE ratio, I do want you to understand the opportunity for the next couple of years would be over a 20% annualized rate of return. So what we're looking here for is some pretty good growth, not much in dividend, but a decent dividend record, and I'll show you dividends here in a moment, and some really neat capital appreciation. If I look at forecasting on operating earnings, there are about 9 analysts reporting for the next couple of years, and right now the estimate for August and by the way, it has an August fiscal year of August 2020 is 340. The company is currently forecasting slightly higher. They're forecasting about 345. So company guidance is a little higher than analyst estimates, but they also came off a very good year. As the Wall Street Journal reported a few hours ago, Jabil's momentum continues with another strong year. They exceeded analyst estimates, and the stock was up 6% at one time. It's currently up about 4.7%. So the stock is starting to appear like it's getting a little momentum. The longer-term growth rate is forecast to be about 12% a year. Now, I also checked that by going to Yahoo Finance, and if you look at Yahoo, they're forecasting the next 5 years at 12% as well. So there does seem to be a consensus of growth. Now, if this were to happen and the stock traded at its normal, let's say 10 to 12 PE, you've got a 15 to 16% annualized rate of return on the high side, and maybe about a 13% rate of return on the lower side. So double-digit returns. If it reverts back to the mean and trades at a 15 PE, then you could easily make 20 or 21% a year. Now let's look at historical performance here. I do want you to notice, I'm going to expand this out for the long run. They didn't start paying a dividend until 2006, and they doubled it the first year, but then they held it steady at 28 cents a share over the course of the next 5 years. And then since that time, they've held it at 32 cents for the last 7 or 8 years, and it's currently paying a dividend at that rate. However, the stock also, if I go back to look at historical performance here, it was a very, very overvalued security here. Now, if I shorten the time frame to where we look more at the company's current growth rate, even though I consider the stock significantly undervalued, I do want you to notice that it has outperformed the market on a total return basis, and that's considering the fact that it's undervalued. If we would give it, my fair value estimate on this company using the 11 or 12 PE would be about 39 to 40. Stock trades at 31. My intrinsic value estimate would be somewhere around 50 or even as high as 58 over the next couple years. So there's a lot of potential, but I do want you to see this here. If this stock trades at those rates, we've got, these 12 PEs, we've got a 24 or 25% compounded annual rate of return available on this stock over the next 2 or 3 years. So it's a little bit spicy. It is growing very fast. It supplies companies like Apple. It ought to do a lot better going forward than it has been in the past, and it does have some momentum currently. I do want you to see their current earnings slide deck here a little bit and just show you some of the results the company's had. The revenues have grown very, very nicely for last year. Went from 22 to 25, I guess that's $1 million. And so the company's had a very strong growth rate. Their GAAP earnings have not been as great, but they had $6.6 billion in revenue. About 37% of their business comes from the diversified manufacturing service, and about 63% from electronics manufacturing. So, the company is well positioned in the technology sector. I want to get into some earnings forecasts here. They're expecting core earnings, that would be diluted earnings, of about $2.98 for fiscal 2020, which ends in August. But they are expecting operating income to grow by double-digit rates, and they're expecting core earnings, which I'll get into here in a moment. That's adjusted operating earnings that I've been showing on the graph to be, been growing at about 17%. So as you go forward and look at the company, they're expecting core earnings of $3.45. Now, the consensus right now is expecting $3.40. So they're guiding now a slightly higher than consensus, which I think is very strong. Now, the company is not a great dividend payer, as I pointed out, but it's a decent dividend payer. I also want to take a quick look at this company based on EBITDA, because I think if you look at EBITDA, you get a really good valuation perspective here on Jabil. Now, once you get past this craziness that we had during the tech bubble and start looking at it more recently, you can see the stock is traded at around 4 times EBITDA, and currently it trades at 3.38 times EBITDA. So again, that would indicate it's undervalued. On a price to EBITDA, this would indicate it's something, from about a $38 to a $40 stock, and you can buy it at 31 today. The forecast EBITDA growth is not quite as strong as we saw with earnings, but still expected to be about 9% growth. And so if we look at that 4% EBITDA, or 4 times EBITDA number, we're looking at 41% total rates of return over the next period, 19% annualized between now and next year. So it's a very interesting little growth stock story. A couple of things I do want to show you that I think are important that may be helping you make a decision on whether you want to research a stock further or not. So let's take a quick look at fund graphs and look at common shares outstanding. As I pointed out, the stock has been trading at kind of a discounted valuation, and so the company has essentially taken a position they're committed to returning as much capital as possible to shareholders. They've been buying back stock. They went from $220 million in the 2011 fiscal year to $175 million last year, and they're actually expected to increase that. They're down to 152 million shares through the May quarter. So the company is buying back stock right now, and they are committed to at least maintaining that dividend, and the dividend is well covered by cash flows and EBITDA. So it's a very interesting company. It's really a total return investment. I will admit that the company isn't my cup of tea necessarily. It doesn't offer enough dividend yield, but I do consider it a very attractively valued, primarily growth stock. I would call this more, the dividend growth is really not there, but the operating earnings growth and EBITDA growth looks very strong, and the company's trading at a very low valuation. So those of you that like to, look for something that might give you a very high total return over the next couple of years, Jabil Inc. or Jabil Circuit as it used to be called might be just something you might want to take a closer look at. Anyway, this has been Chuck Carnival saying thanks for watching. If you like what you saw, don't forget to subscribe to my YouTube channel, where I'm going to start featuring featuring more stocks on a regular basis with different categories. I'll be showing some growth stocks, I'll be showing some dividend stocks, and I'll be showing some higher yielding dividend stocks and some dividend growth stocks. But the idea here is to give you something that you can research further and give you a perspective of how the market might be currently valuing this companies. Hit our subscribe button to keep up with us. Thanks. This has been Chuck Carnevale. Thanks for watching.